let's look at basic materials and leveraged products. So first off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. Okay, we will look at two leveraged. We will look at the bullish one, 2x, basic materials, 285-ish% from the lows, huge move, very close to 52-week highs. We will also look at the bearish one, so you can see it here, so basically, very close to the lows. Okay. We first here look at the seasonality of the XLB, because that is the benchmark materials / sector spider ETF. So looking at the last 20 years, we can see that January is one of the more mediocre months. It's very clear that we have strength building up to April, which is very strong. November is also very strong. When we go even further back in time, in 1998 to 2017, you see that January actually is the weakest month. Even the loss here, -2, is worse than June. So definitively, January is a bearish month. The leveraged products we will look at is the UYM and SMN for the bears. So let's now look at the charts. So this is the long-term picture here for the XLB, looking way back in time. So you can see quite clearly, during bear markets, it goes down very big and up, significantly during a bull. But something that is very interesting about its behavior during a bull market here is that it does actually move in pretty big cycles. So if you measure this fall here as an example, that's -30%, so it had a bit of a bear market there. Here it decided to have another bear market, -26-ish%. Here of course you have the lockdown plunge, which is it's a separate thing. But basically, it's quite clear that the XLB, it works really well in a short, long portfolio. So during a roaring bull market, you can actually have, short positions in basic materials that can be quite profitable. So that's a very interesting observation here, just based on how it behaves. That also means that this huge rally here, it's something we need to be a bit careful about. Are the bulls in control? Obviously they are. You gotta be careful fighting bulls when they are this berserk. Looking here at the RSI, we are getting very overbought. Historically, this ETF doesn't like to be overbought. That's the fact we have here over many years. It usually triggers some kind of a pullback. So that's something to just be aware of. One of the highest RSI levels. There's 83% positive correlation here with S&P 500. When we zoom in here, we do see a little bit of a fatigue, a big move previous week, but seems to be, something is afoot. Nothing dramatic so far, but let's look a bit at the daily data points. Zoom way out to get to the moving averages. Let's just quickly look at the RSI. So the key thing here when looking at the RSI is that we want to see the extent to which basically any of the technical indicators can be used as a buy signal or a sell signal. Hence, as far as the RSI goes, for it to be a good sell signal, you want to see the RSI get up into a high level and then have a sharp reaction downwards, which, suggests that there is some sensitivity. But as an example, let's say that you have a stock or any security which is able to be overbought for a long period, and has done that in the past, multiple times. That means that you simply cannot use the RSI in that way. But yeah, basically that is what we are looking for here. We're looking for indicators and see patterns that are tradable. Here again, on the daily data points, it does seem like the higher RSI level is something that rarely happens for the XLB. It usually has some reaction downwards. And something we saw certainly on the long-term picture is that it every now and then has a big bear market. looking here at the accumulation distribution, we see that it did not corroborate the recent rally. So that is interesting. So there is some bearish divergence there. Very strong correlation with the S&P, 97%. Super strong. Now let's look at the statistical correlation with the leveraged products. So the UYM, that's the one if you are feeling bullish. So you can see that there's a 72% strong correlation. It's a decent correlation, but it means that there is a significant portion here that is tracking error. Looking at the daily data points, we then have a 99% positive correlation. That is very good. So the UYM, it does work pretty well as a leveraged product. Then you have the SMN. That's the one for the bears. So here we have a minus 87%. That actually is pretty good. So you do have that negative correlation that we want to see with the bearish one. Here on the shorter time frame, daily data points, we have minus 99%. That's actually very, very good. So it does, to a significant extent, mirror. Okay. Well, it being operating as the inverse. Okay, so let's get XLB there. Okay. Let's look at some other things. Let's look here at Finviz. They draw these automatic trend lines. We are, flying above here, so definitively overextended. If we go here to, let's go here. Something interesting is observed. So this is, all the data we have. And if we look at the current level here, the distance between price and the 200-day moving average, it is currently at 19.42%. So pretty significant distance. That's big. If we go back here, if you look at this line, you see that we usually aren't that far away. How far was this? Yeah, so basically we have never been this far away from that moving average. So there's two ways to interpret that. You could of course say that this is a sign of very strong bullish momentum. Sure, that is true. That's a fact. However, it also means that as far as putting on a bullish position now, it certainly is not a good time. It just isn't. The basic saying is to buy low and sell high. Hence, as far as using leveraged products, I think it makes more sense for the XLB to look for bearish opportunities. There's just too many signs that it is very overextended, and the XLB, as we saw after the financial crisis, it has a strong tendency to move up big, but also have very deep corrections. Hence, it is very shortable. Whatever you do, of course, in the market, you need to be careful. And when you use leveraged products, you need to monitor them carefully because they can certainly diverge from the underlying index.